Higher home prices and steeper mortgage rates are being blamed for a weak start to the spring housing market, but relief may be on the way from federal housing authorities. That news sent shares of government-run mortgage giants Fannie Mae and Freddie Mac surging today, while some of the nation's biggest home builders, like D.R. Horton, Lennar, and Pulte, all saw modest gains. Diana Olick explains how some new rules aimed at easing credit restrictions may help some home buyers get loans and give a boost to housing.
Fannie Mae and Freddie Mac, which guarantee the vast majority of new mortgages, got new orders today that could make those mortgages a bit cheaper for both banks and borrowers.
We expect Fannie and Freddie to take actions that improve liquidity in the present single-family housing finance market.
To help loosen credit, Fannie and Freddie's new regulator, Mel Watt, announced the two would relax certain standards that result in banks having to buy back bad loans. Watt also said he would not lower loan limits from $417,000, something Watt's predecessor had considered as a way to reduce government share of the mortgage market.
This decision is motivated by concerns about how such a reduction would adversely impact the current health of the housing finance market.
These, in addition to new programs to help some of the hardest hit housing markets like Detroit, are designed to ease credit as all cash investors move out and mortgage-dependent homebuyers move in.
The key takeaway for investors is there's going to be a modest increase in credit availability that's going to help the mortgage market, but I don't think that you're seeing a radical shift at FHFA or at Fannie and Freddie.
In another move to ease credit starting this fall, the FHA, which is the government's mortgage insurer, will lower premiums for borrowers who agree to undergo credit counseling. The FHA, which backs very low down payment loans, lost a lot of customers in the last couple of years when it raised those premiums to protect itself. For Nightly Business Report, I'm Diana Olick in Washington.
So could these new rules loosening credit restrictions really jumpstart the moribund real estate market? And what's the downside to relaxing credit rules? Bob Brusca is chief economist at Fact and Opinion Economics, where he covers the housing market. So, Bob, we all thought that Fannie Mae and Freddie Mac were going to be winding down, not expanding. What's the switch? And is this going to make things better or worse?
Yes, it's going to make things better or worse. That's what it's going to do. I think there is some truth to the idea that there might be some better availability of credit out to certain borrowers, but the bottom line is that the housing market isn't going to be made better really by changing financing rules. It's going to be made better by having a better economy, by having a real low unemployment rate that's created by having job growth, not by having people drop out of the labor force. And you can only do so much with these credit rules. I think at the end of the day, you have to have people that have good credit. And the banks have been concerned because there have been these putbacks from mortgages, and this caused them to be more costly. And so they responded by having higher credit scores, a higher hurdle to get into the market. Well, that hurdle will probably go down a little bit now, but it's not clear it's going to make a dramatic difference.
You know, Bob, a lot of the deals I understand that are getting done these days in housing are all cash deals. Why is that? What does that tell you either about the nature of the economy or the health of the credit markets?
Yeah, the all-cash deals, I think, have been running somewhere a little bit north of 30% of the market. The real problem is that new home buyers are still a very small proportion of the market. New people just can't get into the market. Housing prices are high. And this is the problem. Housing prices were very low for a while and during the crisis, and while that was bad for people who owned houses, it was good for people who wanted to buy them. Well, now the prices have recovered a lot. Mortgage rates also have gone up, and that's increased the size of the hurdle people have to go over in order to be qualified to buy a home. So, you know, that's where some of the problems come from. They come from the fact the economy's done a little bit better and housing prices have recovered.
You know, Bob, you said a moment ago that housing will recover when the economy recovers. You know, a lot of people think that if housing recovers, that'll make the economy stronger. Do we have it backwards?
Well, if you've got a big enough tail, it can wag the dog. But the housing sector is far too small to create the growth that will drive the economy forward.
Prices, though, if you look at the Case-Shiller, are actually year over year quite healthy. Is that actually a bad thing because they've gotten so high in some markets that basically affordability has gone so far down?
Well, of course, you still have some markets that are pretty depressed. You know, my hometown, Detroit, has still depressed very depressed home prices, and that's been the situation there for some time because the economy is depressed. In places where the home prices have gone up, it's because they've recovered from these tremendous sell-offs, and now they've gotten back to levels where they're probably normal or maybe even a little bit high. Whether they're high or not depends on what happens with interest rates in the future. If we get some inflation, if interest rates start to go up, well, that'll drive the home affordability indexes down, and it'll cause put downward pressure on home prices. Home prices can be high when interest rates are low. Interest rates are low now, so there's a relationship there you have to keep in mind. Low interest rates are a big reason why home prices are so high right now.
All right, we're going to have to leave it there, Bob. Bob Brusca, chief economist at Fact and Opinion Economics. Thanks a lot, Bob.
Thank you.